This is Anke Tukral from Edupedia World. To continue the chapter on sources of business finance, let us recapitulate. But before that, I have here to talk on the subject business finance, that is comparison of shares versus debentures. Before coming to the point, that is compare the shares and debentures, let us recapitulate what are equity shares and what are debentures. Equity shares are those shares which do not carry any special or preferential rights in respect of payment of annual dividend and repayment of capital. The money raised by issue of equity shares is termed as equity share capital, whereas in case of debenture is a certificate and a document which is issued under the common seal of the company, acknowledging its debt to the holder at given terms and conditions. The amount of loan, rate of interest, and the security offered are clearly mentioned by the company on that document. So, share is the owner's funds, whereas debentures are the borrowed funds. Now, let us go ahead and see what are the differences, what are the basic points where the shares differs from the debentures. Number one point is nature of funds. In case of shares are considered as part of owner's funds of the company, whereas in case of debentures, they are considered as a borrowed funds of the company or a creditors to the company. Next point of difference is status. In case of shareholders are the owners of the company, whereas debenture holders are the creditor of the company. And nature of return, shareholders get return in the form of dividend, whereas in case of debentures, they get return in the form of interest. Now coming to the next point, rate of return. In case of shares, a dividend fluctuates depending on the residual profits, whereas interest rate is fixed irrespective of the profit. As in case of shares, if the profits are there, dividend is declared, otherwise dividend may not be declared. Whereas in case of debentures, this is a fixed interest rate always getting by the lender. Next point is security. Shares do not create any charge assets of the company, whereas debentures usually have a charge on the assets of the company. Next point is control. Shareholders enjoy voting rights and they are the member of the company, owners of the company, so they enjoy voting rights, whereas debentures do not carry any voting rights. Next point is degree of risk. Shareholders bear a high degree of risk as always return depending on the profits of the company, and repayment of capital may not be there so easily. So higher degree of risk is there in case of shareholders, whereas debenture holders bear minimum degree of risk. Next point is redemption. Shares are not redeemable during the existence of a company, whereas debentures are generally redeemed after a specified period. Next point is borrowing capacity. What is the effect on borrowing capacity? In case of shares, issue of equity shares increases the borrowing capacity of a company, whereas in case of debentures, it reduces the borrowing capacity of a company. Now students, I think everybody is well aware about shares and debentures now, and everybody has understood what is shares and what is debentures, their features and their comparison. Let us go ahead with the other sources of borrowed funds. Now another source of borrowed fund is loans from financial institutions. Now before coming to the loans from financial institutions, let me tell you what is a financial institution is. Financial institution is a company engaged in the business of dealing with monetary transactions such as deposits, loans, investments and currency exchange. Their main function is to provide financial facilities and technical expertise to the institutions. The central and state governments have established various financial institutions in the country to provide finance to business organizations. These institutions are also known as development banks, as their main objective is to promote industrial development of a country. This source is suitable to raise large funds for long-term requirement for expansion, to reorganization and modernization of an enterprise. Besides providing loans requirement to the companies, they also conduct market surveys and provide technical assistance and managerial services to people who run the enterprises. So these are what we can call financial institution and their objective. So what is the role of financial institution? The primary role of financial institution is to provide liquidity to the economy and permit a high level of economic activity than would otherwise be possible. So this is the role of financial institution. Now let us see what are the advantages, what are the merits of loans from financial institution. Number one is medium and long-term finance. Financial institutions provide medium and long-term finance which are not provided by the other authorities, that is commercial banks, etc. Another is assistance in business. Financial institutions also provide financial managerial and technical expertise and give advices and consultancy to business firms whoever requires. Another merit is source of goodwill. Obtaining loan from financial institution increases the goodwill of the borrowing company and it can raise funds easily from other sources as well. Another advantage is easy repayment. Loans from financial institution does not lead to higher burden on the business as loans can be easily repaid in installments. Another advantage is financing at all times. Financing at all times means financing even during depression or recession of a country. Funds can be raised from financial institutions even during periods of depression or recession when other sources of finances are not available. So these are the merits of loans from financial institutions. And let's go ahead and see what are the limitations of loans from financial institution. Number one limitation is processing difficult, means difficult procedure. A number of formalities are required to obtain loans from financial institutions. It makes the procedure time consuming and cumbersome and expensive also. Another limitation of loans from financial institutions is restrictive clauses. Financial institutions may also impose certain restrictions on borrowing company. For example, institution may impose restriction on payment of dividend also. Another limitation is interference in management. Sometimes it is found that financial institutions are unnecessarily interfering in the management of the business. So they may intervene in the management of a company by nominating its representative in the board of directors of the borrowing company. So these are the limitations of financial institutions. So now let's go ahead, students. After covering the financial institutions, their limitations, etc., let us see what are the type of financial institution in India, where they are set up and what is the background. Before coming to the financial institution in India, let me tell you what is the background of these financial institutions. Soon after independence, it was felt that fast industrial growth in the country cannot take place without cheapening and widening channels of industrial finance. A notable step toward this was the establishment of special financial institutions both at the national level and state level. National level, special financial institutions set up by the central government includes IFCI, ICICI, National Industrial Development of Corporation of India, the Industrial Development Bank of India, etc. Such institutions at the state level include the State Financial Corporation and State Industrial Development Corporation. So these were set up as considering for the growth of the economy of a country. Let us see one by one what are the type of financial institutions in India. Number one is IFCI, that is Industrial Finance Corporation of India. It was established in July 1948 to provide assistance for balanced regional development and encouraging new entrepreneurs to enter into priority sector of the economy. This was the major objective and role to be played by IFCI. Another institution is State Financial Corporation. This corporation was established to provide medium and short-term finance to industries like private limited companies, partnership firms, proprietary concerns, etc., which are outside the scope of IFCI. So that's why the State Financial Corporation was set up. Another is ICICI, Industrial Credit and Investment Corporation of India. This was established in 1955 to assist creation, expansion and modernization of industrial enterprise exclusively in the private sector. So they are meant for the private sector funding only. Another institution is IDBI, Industrial Development Bank of India. It was established in 1964 to coordinate activities of other financial institutions including commercial banks. This institution performs three types of functions, namely assistance to other financial institutions, second, direct assistance to industrial concerns, and third, promotion and coordination of financial technical services. Another financial institution was set up in SIDC. What is SIDC? State Industrial Development Corporation. This corporation was established by different states to promote industrial development in their respective states. So this organization was set up to look after the different various states' development. Another institution is UTI. As everybody must be knowing, Unit Trust of India. It was established by the Indian government to mobilize the community's savings and channelize them into productive ventures. Another institution was set up, ILIC. Everybody is well aware of ILIC, Life Insurance Corporation of India. It was set up in 1956 to mobilize the community's savings in the form of insurance premium and to make it available to industrial concerns in the form of direct loans. So these are the financial institutions in India set up by the government and state government. Special financial institutions often plays a vital role in the industrial growth of developing nations like India. Such institutions are operating in many developed countries. Although some of these were in existence prior to World War II, they are mostly a post-war phenomenon. These are the financial institutions with their objectives and with their mandate. So let's wind up today. This is all for today's class. Thank you. Bye bye.